Happening on the markets, starting off with the Asian side of things. Things were looking a little bit mixed. Of course, what is happening on that particular side is that we do have some markets that are closed for holidays. But looking at the mainland Chinese markets, they also had a mixed close, starting with the Shanghai Composite down about 0.5%. However, the Shenzhen component doing the complete opposite, up nearly 0.25%. When we look at what was happening in the side of Japan with the Nikkei, that down over 1.25%. European stocks at this particular point following suit with what's happening with global markets, with that dip that we are seeing flow through. FTSE 100 down 1.33%. The German DAX following suit in negative territory as well, just over 1.2% in negative territory. The French CAC down 1.25%. As we look at U.S. futures, they lower at this particular point in pre-market trading, ahead of more, retail numbers coming through, as well as investors keeping an eye on the FOMC minutes. Of course, over the past few days, including last week, we were taking stock of what some of the Fed presidents were saying, whether it was New York and various parts of America, in terms of trying to get an indication where they think inflation would be going. Do they still believe that inflation is transitory? And of course, we're going to be looking at those FOMC minutes to try and ascertain the language. Has the language changed from the last time? Does it give us an indication as to where it's going? However, while we talk of FOMC markets, while we talk about inflation, which has been one of the key themes that has plagued markets over the past couple of weeks, affecting the tech the tech shares that are pretty much high growth shares with a sensitivity to inflation. When we talk about inflation here, that came out at 4.4%, but we'll unpack that a little bit later with Michael Traherne. But now we move on to something else. Prosus and Naspers surprising shareholders with a proposed restructuring in an effort to reduce the discount to net asset value between Naspers and Prosus, as well as unlock some perceived value in Prosus. So Naspers investors will be able to swap their shares for those of its Dutch-listed unit, Prosus, in an effort to narrow a valuation gap with its Chinese affiliate Tencent. Is it a good deal for Naspers shareholders? Will it work? Most importantly, do we understand what Naspers is attempting to do? And to help us unpack that, we are joined by Pierre Verster, who is the CEO of Protea Capital Management. Pierre, thank you so much for your time this afternoon.
Thanks, Nastasia. Good to be with you.
So I've spoken to a couple of analysts as well. The one described it as a mess. The other one described it as a snake trying to eat another snake. Let's take it back here. I mean, what do you make of this new, complicated idea?
I do think it is complicated. You don't often see companies have significant cross-holdings in each other, which speaks to your snake analogy. Because according to the proposed transaction, Naspers will end up owning 57% of Prosus, but Prosus will in turn end up owning 49.5% of Naspers. And these types of cross structures all around the world have fallen out of favor. They are not good corporate governance, and they lead to excessive complication. Now, if this is a step in the direction of simplification, that would be great. But at the moment, there's still uncertainty because the Naspers management team have not clarified whether this is just a step in a longer-term process. Indeed, they actually said that they see this as a sustainable solution. And I think that is where a lot of the criticism comes from. Because if this is sustainable, it effectively traps a lot of value in Naspers because of this cross-shareholding. And therefore, I think Naspers shareholders are looking at this proposed deal and saying, we struggle to see the value for Naspers.
So how did we get here? I mean, in my intro, I alluded to that discount to NAV with Tencent. But how did we eventually get here?
Yes, so look, holding companies trading at discounts to their underlying investments is nothing new. Generally, holding companies do trade at a discount to the underlying investments. What we have here is, in the old days, Naspers traded at a reasonable discount to its underlying holding in Tencent. But over time, that increased as Naspers became so big in South Africa. It effectively became a big fish in a very small pond, if you look at the market cap of Naspers. Subsequently, they unbundled Prosus, and they thought that would address the discounts because Prosus was going to be a fish swimming in the European pond, being domiciled in the Netherlands, but that actually did not help. And therefore, today we have a discount that is far wider than it ever has been. And whether this complicated deal being proposed is going to further widen it is an open question.
So, I mean, we had the, spin-off in 2019, September 2019, where Prosus was spun off from Naspers. And some say that in order to deal with that stubborn discount, it did work for a while. However, it came up with another problem where the Prosus NAV widened again.
Exactly, and that's exactly the point I was making. So the issue is that if that step that management thought was going to narrow the discount, it actually led to increasing the discount. Who's to say that this deal won't do something similar and actually increase the discount rather than narrow the discount? And that is why a lot of people are cautious about the deal. I think another issue that must be kept in mind is that Naspers is a South African company, the single largest South African company, but Prosus is a company domiciled in the Netherlands. And South Africa still has foreign exchange restrictions. We have specific tax rules when it comes to foreign-controlled companies. And therefore, those rules must also be taken into account by Naspers, and they are quite complex. And this deal has got no tax consequences, which is good, but at the same time, we need to make sure that the tax tail doesn't wag the dog, and that the Naspers management doesn't simply make decisions based on tax, but actually decisions that are in the best long-term interests of Naspers shareholders.
From your experience and, some of the stuff you may have read, does this work, or how would we be able to tell whether it's working or not?
We'll only know after the deal whether it works when we look then what happens to the discount that Naspers and Prosus trade at relative to their underlying value. So everyone is speculating what this might be and whether the deal will work or not. Naspers management believes it will. At the same time, it must be said also that this is going to be a voluntary deal. So Naspers shareholders have got the choice to swap some of their Naspers shares for Prosus shares at a ratio of 2.27. Naspers shareholders can also decide not to do that and simply sit out and see if something happens down the line which is better for them.
Yeah.
So the jury is still out, and that's why there's all these questions, because we are unsure if this proposed deal is going to work or not.
All right, Jean-Pierre, thank you so much for your time, and thank you so much for explaining that to us. That is Jean-Pierre Verster, who is the CEO of Capital Management. But now we move on to the markets picture. As I mentioned, a little bit of the highlights of what happened over in Asia. But to get into that detail, we are joined by Michael Traherne, who is from Vestek Asset Management. Michael, thank you so much for your time this afternoon.
Happy to be here.
So what do you make of the JSE's performance? We saw some company numbers come through as well.
It's been a bit of a volatile session. I think the big thing that's been driving markets probably over the last week at least has been the inflation story in the US, and we saw South African inflation out this morning coming in higher than expected. And I think that's taken off the table any hope of any further MPC interest rate cuts, and as a result we've seen the rand weaken a bit, and the market also looking slightly weaker this morning.
So I was going to ask you on that in terms of where the bets should be going, because some saying that that interest rate hike, we might see it a little bit later on in particularly South Africa.
So if you go by the SABC estimations, they in their own numbers estimate that they're going to raise rates at least once, I think maybe even twice this year. It is worth noting, though, that they've been very cautious in their inflation estimations in terms of overestimating inflation generally. And so far, their inflation estimations have been above where inflation has actually come in. We'll have to wait for the next MPC meeting to see how they react now to the current inflation numbers. It is worth noting that a strong rand helps keep inflation low, but having oil trading at a 2-year high definitely isn't helping that scenario.
Speaking of inflation, over the past couple of weeks, we've had inflation jitters move through the markets, particularly as it relates to U.S. inflation. Are those fears still lingering around in the background?
For sure. I mean, inflation is directly linked to interest rates, and interest rates directly linked to how much money companies can borrow and share prices in general. So having inflation that's too high means interest rates are going to increase, and that's not good news for share prices. So given its significance for the market, it's something that will hang around for a long time. Well, until there's something else bigger to worry the market. These things always move in cycles. But if you're a long-term investor, you're going to see all these cycles come and go. It's nothing to get too worried about. Keep putting your money away on a monthly basis, and keep your head down. Ignore the noise.
Something that has been taking place that I found quite interesting is the performance of gold prices, holding, relatively steady over the past 3 days. Any indication as to, what's keeping them at those particular levels?
I think it comes straight back to our inflation conversation. Gold generally does well when the market's expecting high inflation, and if you have a look at the gold price since the beginning of the month, it's bounced off around about $1,700 an ounce to the almost $1,800 it's at the moment. And that's it's all based on inflation. When you're worried about inflation, people go to gold as a hedge against inflation, and that's sort of what we're seeing at the moment.
We have the FOMC minutes that we are expecting a little bit later on today. Any particular thing that you're going to be looking out for, or are you just going to wait for the media to report it for you overnight?
Yeah, I'll be asleep more than likely, so wait for the media tomorrow. But it's again inflation. That's the big topic that we'll be looking at. The FOMC or the US Fed. They've said that they're expecting a short-term spike in inflation, and as such, they're not going to react. Let's see if that was the sentiment expressed at their latest meeting. More than likely it will be, because we've heard Fed members speak to the public since their last meeting. But those are the main things that the market will be looking at. Are there any indications of when the Fed is going to raise interest rates, and the market will adjust accordingly?
So here's a thing where I'm going to switch gears a little bit and probably ask you a very interesting question. So you had Anglo American releasing their rough diamond sales. And I'm curious, are you for synthetic lab diamonds, or are you for diamonds that are mined the old school way?
So you've been reading our newsletter, Anastasia. Yeah, I'm a millennial, and I'm an economist at heart. So if the rock's synthetic diamond at third of the price, and it's flawless and it's super shiny, why not for the synthetic version?
All right. So the one thing, as we talk about that newsletter, and if any of our viewers are interested in reading up a little bit about the view on synthetic diamonds, or even far more interesting, Lamborghinis, which you touch on a little bit earlier on, and one of the reasons that you talk about it is that they've charted a course to become fully electric in the coming years. I mean, take us briefly through that bit.
That's sort of the trend that global car makers or automakers are going through at the moment, where executives are planning their 20-year timelines, and part of that is to go hybrid, and then from hybrid to fully electric. And that's in line with global sustainability goals. At the moment, you look at the EU and the US, 30% of emissions come from cars. So it makes sense that cars are going to be converted to fully electric. I must say, though, as a supercar fan, it would be a bit sad if a Lamborghini's got an electric engine. You don't quite have that same engine roar from an electric motor.
All right, Michael, thank you so much for your time. That is Michael Traherne from Investec Asset Management, talking to us about what happened on the markets, and also that interesting newsletter where you can get all kinds of news insights from Investec. That's it from me. We're going to have more news with my colleague Nzinga Gunter, and I'll be back tomorrow with markets and, of course, that MPC announcement that we will be covering for you. Goodbye.